Today, we're taking a deep dive into one of the most powerful wealth building strategies used by the ultra wealthy, private equity.
That's right. Private equity involves investing in private businesses, companies that are not listed on the stock market. Instead of buying shares on a public exchange, you invest directly through a private deal or through a private equity fund.
Private equity can include growth equity, investing in a business to help it expand, buyouts, acquiring entire companies, or even distressed investing, buying struggling companies and turning them around. The goal is to grow these businesses, improve their operations, and eventually sell them for a profit, often at a much higher valuation. Before we score private equity on our investability scale, let's talk about where it sits on the capital stack, because that helps you understand both risk and reward. Capital stack is just a fancy term for describing who gets paid first if something goes wrong. At the top of the capital stack is equity. Those are the owners. At the bottom is senior debt, banks and lenders who get paid first.
Private equity sits in the equity portion of the capital stack. That means as an equity investor, you get whatever profits are left after all debt holders are paid. That's why returns can be so high, because you benefit from the growth and value creation. But it's also why risk is higher. If things go wrong, equity holders can lose everything.
Now let's use the Fastfire investability scale to break this down. Starting with return potential, we give private equity an A. Historically, top-tier private equity funds have delivered double-digit annual returns, often in the 12 to 15% range, beating public markets.
Next is risk profile. We give private equity a D. You're taking business risk, execution risk, and market risk. Some investments do exceptionally well, but others can fail completely. The key is investing with experienced managers who have a strong track record of value creation.
And finally, accessibility. We give private equity a D as well. Most private equity funds require you to be an accredited investor, and minimums can start at $250,000 or more. That puts it out of reach for many high-income professionals.
But that's where Fastfire Capital steps in. We're working to create pooled investment structures that allow our community to invest at much lower minimums, making these opportunities accessible to more people.
Let's walk through a real-world example. Imagine we invest in a private equity fund that acquires several mid-sized businesses. Over 7 years, the fund grows revenue, improves operations, and sells the businesses for a profit. If the fund delivers a 15% annualized return, a $100,000 investment can grow to nearly $270,000.
That's the upside. But remember, this is a long-term, illiquid investment. Your capital could be locked up for 7 to 10 years, and there's no guarantee that you'll get it back if the fund performs poorly.
So who is private equity right for? Accredited investors with capital they can set aside for 7 to 10 years. Those looking for higher than market returns, and investors comfortable with business risk and relying on expert operators.
It's not a good fit if you need liquidity, prefer short-term investments, or have a low tolerance for risk.
To summarize, here's our private equity scores. Return potential is an A, risk profile is a D, and accessibility is a D.
If you want to compare private equity side by side with other alternative asset classes, download our full 2025 Guide to Alternative Investments at fastfirecapital.com/guide.
And be sure to subscribe so you don't miss future videos where we'll break down other alternative investments and help you build your portfolio like the ultra wealthy. We'll see you next time.